Hello, and on this episode of the Mortgage and Protection Podcast, we have Paul Holland joining us from Henchurch Lane to talk all about mortgages for company directors on PAYE. It's great to chat with you again, Paul. How's it all going?
Very well, thank you, Tessa. How are you?
Good, not too bad, thank you. Got a little bit of a cold, which you could probably hear. I think you've been in the same way, haven't you? But
Yeah,
hopefully it's
recently had
going.
man flu myself.
There we go. I mean, we are recording this episode in March 2024, so the colds are about, aren't they? But
Yeah,
spring is coming, so hopefully we'll
it
be
is.
okay.
Fingers
Now,
crossed.
yeah, definitely. We've got quite a few questions here, haven't we, on the episodes
We have.
today? Now, we did do a series of self-employed mini episodes, didn't we, previously? But now we're expanding on those. So this is all about our company directors on PAYE. So first of all, then, can you explain what a company director on PAYE is? Can a company director on PAYE get a mortgage? Is it more difficult?
Okay, so a company director will have the option to pay themselves via the PAYE system. That's always an option for a director. They also have the option to pay themselves with dividends, and most will likely take a combination of the two. So a normal setup, or a very common setup, is a small salary that doesn't encroach upon the point where they have to start paying lots of national insurance, and the rest of it is paid with dividends. Regardless of how they choose to remunerate themselves, if they own more than 20%, 20 or 25%, depending on which lender, 20 or 25% of the shares within the business, a mortgage lender will treat them as a self-employed applicant. And we all know it's more difficult for a self-employed applicant to secure a mortgage. But if they don't own shares within the business, they'll be treated as an employed applicant. If they do, to the point of 20 or 25%, then it's going to be treated as a self-employed applicant. Okay, so there tends to be a little bit of misconception with buyers or applicants sometimes, whereby they think because they're fully PAYE within their company that they'll be treated as an employed applicant. And it's simply not the case. If they effectively are the business, then they will be treated as a self-employed applicant.
Right. Okay. So hopefully that's clear to anyone watching this, listening to this. So a key point to take away there. Now, people would like to know, can I still get a mortgage if I'm a company director on PAYE and I only have 1 year's accounts?
So if you're a shareholding director, then securing a mortgage with just 1 year's worth of accounts will be the same process as someone paying themselves a dividend, right? So very similar to any other self-employed person. It is possible. We do it regularly for our clients. You'll only have access to a limited number of lenders who allow that criteria. And of course, you'll need a good credit status or a credit status that fits their credit score and a deposit. But yes, if you've got a 1 year's worth of accounts submitted to HMRC, regardless of how you pay yourself through your limited company, you should be in a position to secure a mortgage subject to all of the other things you need to do.
Okay. So that's good news there, hopefully reassuring.
Yeah.
Now, again, the next question is on income. So, how will lenders assess my income as a company director on a PAYE? How is affordability calculated?
Okay. So there are two ways that a lender will assess a company director's income. If you own shares of more than 20 or 25% of the business, the first way is by using your salary and your dividends. Of course, if you are fully PAYE, then they'll just use your salary. They will then normally look to average that out for the latest 2 years, and they'll usually do that unless the figure or the trend is on a downward scale, right? So if it's going down from year to year, they'll take the most recent year. If you've only been trading for 1 year, then we can approach lenders that would just use that 1 year and who would accept 1 year's worth of trading. The other method is using your salary plus your share of the net profit. So if the business has got profit left in the business each year, then that can be a game changer for people from an affordability perspective. Okay, I think with regards to how much you can borrow, there might be a question later on that we touch on with that will
Yes.
go into detail, but it's very similar to at that stage. Once you've figured out what that number is, it's very similar to an employed applicant.
Okay. Now, just following on from that, then, what documents do I need to prepare? Preparation is key, isn't it, here?
It is, yeah. Yeah, this is again where this misconception comes in. So people think, oh, I've got my 3 pay slips because I'm fully PAYE. Again, it's not the case. If you've got those shares within the business, it's going to be based on the history, right? So the HMRC submission. So we're going to need your latest 2 years company accounts, latest 2 years SA 302s, aka tax calculations, and your latest 2 years corresponding tax year overview documents, all of which you'll only need 1 year if you've been trading for less than 2 years. You'll also need latest 3 months bank statements, personally and from the business, and then 2 sets of name and address ID, as well as your proof of deposit, which is pretty standard for everyone.
Okay.
That's pretty much it in a nutshell from a document perspective. But yeah, a lot of PAYE directors will come to you with 3 months worth of pay slips, and the lenders don't need to see that.
Okay, brilliant. There we go. So a clear breakdown there on documents. We do have a question on the pay slips there. What if my pay slips are not considered as PAYE income?
Yeah, okay.
Which
So I think,
which
again, what this question means is, what if I'm not considered an employee if I'm on PAYE only pay? As we've mentioned, the big confusion within the mortgage world, whereby limited company owners think that because they're in fact an employee from a technical point of view, according to HMRC, that a mortgage lender will view them as an employed applicant. And it's simply not the case. If you own, like I say, 25% shares or more in the business, then every lender will assess your income as a self-employed person. This, in short, means that at the very least, 1 year's worth of personal and business accounts have been submitted to HMRC. And you can't just start paying yourself a salary of 100K a year and then next month get a £400,000 mortgage. And you're certainly not the first person who has thought of this genius loophole either, I'm afraid.
Okay. Well, hopefully that's clear there then. Okay, so we're about halfway through the questions now, Paul. So the next one here asks, and you did allude to this a little bit earlier on, but how much can I borrow and what deposit will I need?
Yeah, okay. So from a maximum loan perspective, income calculators are very similar across the board. So the difference lies in how each lender will arrive at the income figure that's entered into the calculator to begin with, right? So if you own a business, the most common method is to average out the latest 2 years or take the lower if it's on a downward trend. They'll either be using a combination of salary and dividends or salary and share of net profit, depending on what lender you approach. So once they've worked out that figure, punch that into the calculator, and then you're very similar to any other applicant where they use a multiple and then start taking away your commitments off the maximum loan, and it leaves you with the maximum borrowing amount for you personally.
Okay. Okay, there we go. So the next question here asks then, can I get a buy-to-let mortgage as a company director on PAYE? Any differences?
You can get a buy-to-let mortgage with no income at all. So that normally explains the situation overall. Buy-to-lets, in the most part, base their affordability by using the rental income from the subject property. Some lenders have a personal minimum income level, but some don't. So if you're looking to invest in a buy-to-let property and you have access to a deposit and a half decent credit status, then I would start making inquiries as soon as you can, as there's a good chance you could secure something.
Right, okay, there we go. So the next question we have here asks, how does bad credit affect me getting a mortgage as a company director on PAYE?
Exactly the same as everyone else. Good credit normally means better rates. Impaired credit can either mean higher rates or a decline, depending on just how bad it is, really. Every lender is different. So the best thing to do, I would say, is download a multi-agency credit report and speak to a broker. Even if you can't secure something right now, any decent broker will tell you what changes you need to make and give you some sort of plan of attack as to how to get yourself in a position to be ready to go.
Okay, so again, hopefully that sounds reassuring there. And again, another question here, it asks, how does remortgaging work as a company director on PAYE? Again, any differences in the process here?
All of the above, basically. If you're going to follow what we've been through and take that all on board, then you're not going to go wrong. A remortgage application is the same as a purchase application. So if you've made changes in recent years since you last did your mortgage that you think are going to be a hindrance to you, then rather than remortgage, maybe you should be looking at doing something called a product switch with your existing lender. And this will effectively let you achieve a new rate without having to have a full income assessment, which can really help when it comes to the end of your current fixed rate. And it's going to avoid you falling into the dreaded standard variable rates, which are going to be 8-9%. So you don't always have to move lenders. And if your income doesn't allow that, then a product switch might be a better approach for you until your accounts get to that position where you can start to approach new lenders for new deals.
Okay, so something to bear in mind there then. And just lastly, and as always, we like to do a little summary, don't we? So, how can a mortgage broker help in this instance? Have you got anything else to add or any examples where you've helped some company directors out here?
I mean, yeah, we do. We deal with people like this all the time in terms of company directors. Some of them will naturally assume because of their situation that things are so difficult, they get overwhelmed and they start coming to you with, oh, I've just started paying myself this much and I've done this or I've made this decision. And actually, a lot of the times it's overcomplicated things. So I would say before you start making big changes when it comes to finances, company setups, incomes, and things like that, it's probably worth having a chat, not only with the broker, but with someone that specializes within the self-employed world. Because even after speaking to people that have spoken with brokers, in some instances, unfortunately, they themselves have given the client the wrong advice, and they've made some big changes that didn't need to be made, ended up potentially paying more tax or just being in a less ideal situation as a result of that. So it is a really, really complex world when it comes to director mortgages, the self-employed in general. And I know we bang this drum all of the time and we ask people, preparation is key, speak to a broker. But it doesn't hurt saying it again, because it's only going to benefit them in the long run. And we deal with people all the time that really could have made much better progress by speaking to someone a little bit sooner. So yeah, that's key, really, preparation, and speak to someone that knows what they're talking about.
Okay, there we go. So some key pointers to take away from this episode. Thank you for that, as always, Paul. And I'm sure we'll be back next time with another episode.
Great. Thank you for your time, Tessa. Take care.